So today we are going to learn about valuation of bond and the analysis of the bond. So what you are going to learn in this topic, we are going to learn about the fundamentals of the bond valuation. You have learned about bond valuation before this. You know how to value the bond. But in this chapter, you're going to learn from where the formula is being derived and what are the fundamentals of the bond valuation, right? So then you learn about bond valuation. So we just do the revision on what you have learned in financial management. Next, what would determine the interest rates. Next is the forward rates from the spot rate curve, term structure theories, and the price volatility for bonds. So these are the course outline of analysis and bond valuation. So these are the fundamentals of bond valuation. So actually, bond valuation, before this you learn that the price of bond, so basically the valuation of bond is equal to coupon payment times with PVIFA with a given I and N plus par value times with PVIF with a given I and N. Okay, am I right? So these are the formula that you learn how to value the bond. So here, what it shows here is this is the summation of coupon payment divided by 2. Then this answer you divide by 1 plus the answer of 1 divided by 2. So this answer you times by the years. So this formula, when you sum up this formula, it come out with PVIFA, and then you need to find the IN. And so N actually is the maturity years, which is here is the T, I is the ILA, is the interest rate. So it is the summation. So PVIFA is a summary of the summation of coupon payment divided by 2 divided by 1 plus I divided by 2 to the power of N. Okay, so next is this part. This part is actually par value. This is the par value divided by 1 plus I divided by 2 to the power of N to N. So it is actually the N is 2. Okay, so this is the fundamental now, the valuation of bond. So actually what you learn about valuation of bond, actually you want to find the price of the bond today. Right, it is the present value model. It comes from the idea of present value. So PM is actually the current market price of the bond. N is the numbers of years of the maturity. C is the annual coupon payment. I is the prevailing yield to maturity. PP is the value of the bond. So the price yield curve, there exists inverse relationship between bond price and bond yield to maturity. It's required of it. So if the yield less than coupon rate, so the bond will be priced at a premium. If the yield is more than the coupon rate, the bond will price at a discount. if the price yield, if the price yield relation, price yield relationship is convex. Okay, so it's like this lah. Okay, so see the exhibit. Okay, let us see the next slide. Okay, so if you can see here, start with 8 because the coupon rate is 8%. Okay, so when the coupon rate is equal to the YTM at the required rate of return, that the price of bond will be at par. Okay, if the required rate of return is less than, you can see here, this is less than coupon, so the price is at premium. It means that the price of bond is higher. But if the yield is more than the coupon payment, so the price of bond will be at discount. The discount means that the price is lower. At premium, the price is higher. Okay, that's why it says that the price of the bond is convex. It's like this. It's like this. So the yield model is like this. Instead of computing the bond price, one can use the same formula to compute the discount rate given by the price for the bond. Okay, these are the different name of yield measure. The nominal yield, actually it measures the coupon rate. Current yield, it measures the current income rate. Promised yield to maturity, it measures the expected rate of return for bond held to maturity. Promised yield to call, it measures expected rate of return for bond held for first call date. Realized or horizontal yield, it measures expected rate of return for a bond likely to be sold prior to maturity. It considers a specified reinvestment assumption and an estimated sales price. So different types of yield would measure the different purposes. Okay, promised yield to maturity. It is computed in exactly the same way as described in yield model earlier. Widely used bond yield measure, it assumes investors hold bonds to maturity. All the bonds cash flow is reinvested at the computed yield to maturity. Yield to maturity is used with an assumption that all investors will hold the bond until to maturity. Okay, but yet in reality, usually it depends lah. Sometimes the bond holder will sell it before it reach the maturity. Yes, so we call it as yield to call. Okay, so yield to call means that it is less than maturity years. Okay, this is how to calculate the future bond price. Before this, we calculate the present value of the bond. Now we want to calculate what is the future value of the bond prices. So this is the pricing formula. Where PF is the future selling price. for the bond. P is the par value of the bond. Annual coupon payment. C is the annual coupon payment. N is the numbers of years to maturity. So here is the numbers of years to maturity. HP is the holding period of the bond. So if the bond is being called after 10 years, but yet the maturity years is 10 is for example is 15 years. So how much is the holding period for the bond? So basically the holding period is another 5 years lah. Okay. So I is the expected market, YTM at the end of the holding period. Okay, so the I is the interest rate. So yield adjustment for tax exempt bond, because some of the bond there got tax exemption. So example like municipal bond, treasury issue, and many agency obligation possess one common characteristic: their interest income is partially or not or fully tax exempt. Because why this happened is because of the issuer of the bond or the government. The government will exempt the tax payment. Okay, so how it is? So fully taxable yield equivalent, so it is I divided by 1 minus tax. Okay, so tax amount should be in decimal point. Then you will get how much is the interest with the exemption. Fully taxable equivalent. So it's basically we want to know how much is the interest rate after deducting the without deduct the tax. So how much it is? So it is FTEY. Fully taxable yield equivalent. Okay, so these are the concept of bond valuation using the spot rate. Okay, so the formula is like this: the summation of 2n, the time is equal to 1. So PM is the market price of the bond. The cash flow at the time is CT is a cash flow at time T. The numbers of years is N. N is the numbers of years. IT is a spot rate for treasury security at the maturity. T. So T is the maturity. Okay. Let us look at exhibit 18.5. So if the spot rate, here is the spot rate. So this is the maturity years. So 0.5, 1.5. So bond A. Bond A, the coupon payment is 60. Bond B, the coupon payment is 30. And then there is no payment for bond C. So these are the present value for each of the bonds. So what determines the interest rate? Basically, the interest rate is inverse relationship with the bond price. If the bond price increase, the interest rate is decrease. Sorry, it's vice versa. If the interest rate increase, the bond price will decrease. If the interest rate decrease, the bond price will increase. So it is inverse relationship. So it depends on the interest rate. The interest rate will affect the price of the bond. Okay, it's not bond affect the interest rate. It is interest rate will affect the bond price. Okay, so forecasting the interest rates and fundamental of the interest rate, it is interest rate, it comes from the risk-free rate plus the inflation rate plus risk premium. So risk premium, it depends on the industry and the economic condition. Risk-free is based on how much is the rate of the municipal bond. Because usually the municipal bond or the government bond will determine how much is the risk-free rate. Because risk-free rate means that there is no risk. How much do you invest? You are assured to earn that much of return. That's why we call it as risk-free rate. Inflation and also the risk premium, it is fluctuate. It depends on the current situation, the industry, as well as the economic sector. So yeah, it effect of the growth of the economic factors, the real growth rate, the tightness or ease of the capital, expected inflation, supply and demand of the loanable funds. So these are the things which affect the interest rate. Okay, the impact of one characteristics, it depends on the credit quality. Okay, credit quality means that what is the types of the bond? The bond is being rated. Usually the bond is being rated. It depends on either it is AAA or AA or AB, AAC. So maksudnya kalau AAC, it is not so good lah because there is C. A good one is triple A. Okay, but usually because the one who give the rate to the one who, because there is an agency which the provide the quality, we call them as credit agency. No, it's not credit agency. There is a name lah actually. The rating agency, sorry, we call them as rating agency. So this agency, they will rate the bond, whether the bond is good or not. So there are certain criteria that the bond need to fulfill in order for them to get a good rating. Okay. So second is term to maturity. So it depends on how long is the maturity years. The indentures provision, foreign bond risk, including exchange rate risk and country risk. So you'll see the risk that associated with the bond. If the bond is a foreign bond, we will see about the country, about the politicians' situation of the country. So all those things will affect, will give impact on the price of the bond. Term structure of interest rate, it is static function that relates the term to maturity, the yield to maturity for sample of bonds at a given point in time. The types of yield curve, so rising in yield curve, so the yield on short-term maturities are lower than the longer maturities. So flat yield curve is equal yield on all issues. Declining yield curve, yield on short-term issues are higher than longer maturities. Okay, let us look at exhibit, the next exhibit. Okay, so this is yield on US Treasury securities with alternative maturities at a different times. So if you can see that, the time to maturity, so the yield, the time to maturity for the first one is longer. So it is longer, which is 15 April 2008. So it is 15 April 2008. So from 1% it increased to 4.5%. 4.445. 4.45. But for the longer maturity, it just static like this. 2007, both are 2007. It's static. It's just at this curve. So it's not much. Okay. In fact, it is volatile. There is not much increase. So actually, so the longer maturity will give a higher return. Okay, so a rising yield curve is formed when the yield on short-term issues are low and rise consistently with the longer maturities and flatten out at the extremes. So this is yield on short-term issues. All right, so this part. A declining yield curve is formed when the yield on short-term issues are high. It started high, then it started to decline consistently. A flat yield curve has approximately equal yield on short-term and long-term issues. So basically this part is there is no difference for short-term or long-term. So the humped yield curve is formed when yield on intermediate term issues are above those on short-term issues and the rates on the long-term issues decline to level below those for the short-term and then level out. So this is because of it is intermediate. Okay, so it started to decrease, but yet it started to decline, so which is not good. So the best types of yield curve is it start low, but it consistently increase like this. So this one is better. So the concept of spot rate and forward rates. So spot rate is defined as discount rate for a cash flow at a specific maturity. Forward rate, it refers to the expectation of future short-term rates. Okay, so it's creating the theoretical spot rate curve, calculating the forward rate from the spot rate curve. So next, we are going to talk about term structure theory. Term structure theory is a theory on the structure of the bond. So the first one is the expectation hypothesis. So any long-term interest rate, it simply represents the geometric mean of the current and future 1 year interest rates expected to prevail over the maturity of the issue. So basically, it can explain any shape of the yield curve. So it explains the curve of the interest rate. All right. The curve will explain what's going to happen in the future. The expectation for rising short-term rates in the future cause a rising yield curve. So basically, if the short-term rates, if there is an expectation for the short-term rates increase, so the yield curve is started to increase. So it depends on the short-term expectation. All right. So the expectation for falling short-term rates in the future will cause the declining yield curve. And then the similar explanation account for fleet and hump yield curve. So basically it depends on the expectation. So people will see at the during the short term, either the curve is rising or the curve is declining. So if they see that it is decline, so the future also will continues declining. So the performance for the short term is very important because it will move the performance in the future. Because this is what the expectation hypothesis theories are. Because everything that happen is depends on what they expect. Okay. Second, term structure theory, it is liquidity preference theory. So it depends on the liquidity of the company. All right. So the long-term securities should provide higher returns than short-term obligations because investors are willing to sacrifice some yields to invest in short maturity obligations to avoid a higher price volatility of long-term bonds. So basically, this theory argues that the yield curve should generally slope upward and that any other shape should be viewed as temporary aberration. So basically, it is not follow the expectation hypothesis. Okay, because the most important is the higher return. So the expect that in the future, what happened for the short term, it doesn't matter. But the most important is the growth of the bond. So the growth is more matter because they prefer that the bond is going to be profitable in the future. Next is the segmented market hypothesis. So different institutional investors have different maturity needs that lead them to confine their security selection to specified maturity segments. And yield for the segment depends on the supply and demand within that maturity segment. This theory contends that the shape of the yield curve ultimately is function of the investment policies of major financial institutions. The segmented market, so basically the investors are well educated. They understand what is the purpose of the bonds itself. So what are the bonds that they want to invest? They will choose what types of industry that they want to invest. It depends like either they prefer on the what types of industry or what types of the bonds itself. So they already know the bonds that they want to invest. Trading implications. So trading implication basically it depends on the supply and demand. So people will see trading implications. It depends on the current situation. Okay, the mentality of the investors is not same like segmented market hypothesis. So these theories, the theory of trading implication of term structure, the theory stated that the investors are more they more see the what what's happening today lah. Okay, if the trading is good, they see that the bond is good, then they will start to invest. If they see that the bond seem like there is not good at all, so they will not invest in the bond. The yield spread. Major yield spread segments, for the segments, common, it is government bond, agency bond, and corporate bond. So these are the segments of the yield spread. So the sectors, it is prime grade municipal bond versus good grade municipal bonds. So AAA utilities versus BBB utilities. So primary grade is good, but good grade municipal bond also good. Both bonds are good, but it depends on people who are going to choose what types of bond that they want to invest. Coupons are seasoning within segment or sectors, maturities within a given market segment or sectors. So magnitudes and the direction of the yield spread can change over time. So the price volatility for bond price is function for one par value. The first one is par value. Second is coupon payment. Third is years to maturity. Fourth is the prevailing market interest. So there are four things that are most important for bond price to function. It means if you have to find a bond price, you need the information of par value, coupon payment, maturities, how much is the maturity years, and the prevailing market interest. So these four things is very important. Okay. Bond price change or volatility is measured as a percentage change in the bond price. So how to calculate it? It is EPB divided by BPB. It's not PBB, it's BPB minus 1. So what is EPB? EPB is the ending price of the bond. BPB is the beginning price of the bond. Okay, so basically, today minus yesterday. Sorry, today divide yesterday. Today's price divide yesterday's price minus 1. And then you will get how much is the changes of or the volatility of the bond price. All right, so there are 5 important relationships on the price volatility for bond. First is bond price move inversely to bond yields. So as I said earlier, if the bond yield increase, the bond price will decrease. If the bond yield decrease, the bond price will increase. Okay, so they move inversely. For a given change in yields, longer maturity, bond post larger price changes. Thus, bond price volatility is directly related to maturity. So maturity also affect the price of the bond. The price volatility increase at the diminishing rate at the term maturity increase. So it means that as price increase or as the price volatility increase, but when it near to the maturity, the volatility would be lesser. Okay, the price movement resulting from the equal absolute increase or decrease in yield are not symmetrical, Higher coupon issues show smaller percentage price fluctuation for a given change in yield. Thus, bond price volatility is inversely related to coupon. So the maturity effect, the price volatility also depends on the maturity effect. So the longer maturity bond experience a greater price volatility. Price volatility increase at a decreasing rate with the maturity. Let us look at exhibit 18.12. So the longer maturity bond experience a greater price volatility. So 30 years is a longer maturity bond. So the price volatility increase at a decreasing rate with the maturity. If you can see here, for 10%, for 30 years, the YTM 10%, the present value is 54. Okay, but compared to 1 year, 10%, the present value is 907. Okay, but for 7%, it is higher. It is 132, but for 7% for 1 year, it is 75, and present value of interest is 75. Present value of principal is 934. So percentage change in total for 1 year is lesser compared to percentage change for 30 years. So that's why it says that price volatility increase at a decreasing rate with the maturity. A longer maturity bond experience a greater price volatility. All right, so the yield leverage effect, so you can read by your own. Trading strategies, so you can read by your own. So please look at this exhibit 18 and 14. So the percentage change in total, it is decreasing. It's like this. It is at diminishing rate. Starting at like 14.1, then it increased to 21. 5, then it decreased to 27, but then it decreased to only 11. So I think that's all. So we will continue with macroevaluation next.